Okay, so if you've been watching the markets at all, I mean, even casually over the last, 18 months, you know the AI boom isn't just coming anymore, it's here. It feels like a full-blown industrial revolution.
It really does. Just explosive growth. You see it everywhere, especially these massive data center buildouts.
Exactly. And powering all that, high-performance semiconductors, they're like the digital crude oil of this whole shift.
That's a great way to put it. The absolute engine.
So our mission today is really to try and cut through some of the noise around this. We're diving into this really interesting analysis piece. It takes a bit of an unusual angle, actually.
Yeah. What's the angle?
Well, their whole thesis is that the best way to play this AI wave isn't about super complex valuation models or anything like that. It's simpler. It's about learning how to follow the money flows.
Ah, okay. Following the institutional money. That's a classic approach, but often hard to track in real time.
Right. And this source claims they can track it. They've apparently got proprietary software that monitors institutional demand, what they call the real big capital, and they've used it to pinpoint the top 3 tech stocks for right now, October 2025.
Interesting. So they're trying to see where the big funds are placing their bets before it becomes obvious news.
Precisely. So, okay, let's unpack this a bit. Before we even get to the names on their list, we need to understand the mechanism they're talking about. What exactly are these money flows, and why should we believe they're a better predictor than, say, just looking at fundamentals?
Yeah, that's the absolute crucial part because if you boil Wall Street down to its basics, stocks move on supply and demand. Simple as that.
Right. More buyers than sellers, price goes up.
Exactly. And high consistent demand sends stocks higher over time.
Yeah.
Now, the source argues that with the Fed potentially looking at rate cuts, money's flowing back into growth areas.
Yeah.
And semiconductors, they're just perfectly positioned for that.
Okay, that makes sense contextually, but the money flow part.
Right. So when they talk about money flow, they don't just mean the trading volume you see on like a Yahoo Finance chart. It's deeper.
Okay.
They're talking about a quantitative method designed specifically to spot conviction. The software looks for large, high-conviction institutional block orders. The huge buys and sells that often happen off the regular exchanges, sometimes in dark pools.
So the stuff that doesn't always immediately show up in the public order book?
Precisely. Think about those 13F filings institutions have to release. By the time you see where they put their money last quarter, it's ancient history, right?
Orderly lagging information.
This tracking, they claim, tries to spot that high conviction buying almost as it happens. The core idea is this. If a company is genuinely set for a massive, sustained rally, it'll almost always show one key trait.
Which is?
Continual large-scale buying by institutions. It signals that the big capital, as they call it, is building a serious position. The goal, really, is to find the next NVIDIA early, before everyone else jumps on board.
That distinction is really important then. It's not just volume, it's the signature of that institutional conviction, that steady accumulation that basically shouts, "We think something big is coming."
You got it. That's the theory.
Okay, fascinating. So let's get into the companies that are supposedly flashing these signals right now. Instead of just, rattling off a list, maybe we can group these 3 based on their role in this whole AI infrastructure build out.
Yeah, I like that. That makes more sense conceptually. We could look at them as representing different layers of this boom.
All right, let's start with the first one. We could call this maybe the cyclical turnaround and essential component, Micron Technology, ticker MU. This is the #1 stock in their ranking. And it's a big one, about a $214 billion market cap.
Right, Micron. They're absolutely essential. You can't build AI models without memory and storage, and that's their bread and butter.
Smack in the middle of the semiconductor space.
Exactly.
Yeah.
But historically, MU has been, super cyclical, boom and bust memory cycles. What's driving the institutional flows now, according to this analysis, is a combo. It's strong AI demand, which feels less cyclical, plus a real improvement they're seeing in their traditional server business. It suggests the memory cycle might have finally turned a corner for real this time.
Okay, so it's not just the AI hype, it's the core business showing strength too.
That seems to be the argument. And the financials that really lit the fuse, the rocket fuel, as the source calls it, wasn't just that they beat Q4 estimates. I mean, that was good, but markets look forward.
It was a guidance, right?
Absolutely. Their guidance for Q1 wasn't just good, it crushed expectations. They projected earnings per share, I think it's $3.75. Wall Street was way down at like $3.10. Huge beat.
Wow.
And revenue guidance, too, $12.5 billion versus estimates closer to $11.9 billion. So a beat and a significant raise.
Okay, yeah. For a company known for cycles, signaling that kind of powerful, positive turn, not just beating the past, but raising the future so much, that's exactly when you'd expect the big money to pile in fast.
That's the trigger.
And here's where it gets really interesting, connecting that fundamental news to their flow tracking data. MU shares apparently logged 21 continuous inflow signals.
21 days straight.
Yep. Meaning for 21 trading days, big capital was just consistently accumulating big blocks of stock. This started back in early June, apparently. And this sustained buying, this multi-week sponsorship, is what they say, powered the stock up, wait for it, 80% since that first buy signal hit.
80%. See, that's not a one-day reaction to earnings. That's sustained belief.
Exactly. It shows institutions weren't just popping the stock on a news release. They were building long-term positions because they bought into that guidance, bought into the whole AI memory demand story lasting.
That consistency is the key signal they're looking for. It separates noise from conviction.
Okay, let's move to the next one. Number 2 on their list. We're calling this the AI core and ecosystem leader. Advanced Micro Devices, AMD, another giant. Hypergrowth semiconductor player, $387 billion market cap. Needs no introduction, really.
Right, AMD. You could definitely call them the ultimate AI trade right now, or at least one of them. They're going head-to-head in that critical data center hardware space.
AI accelerators, CPUs, GPUs, the whole package.
Yep, the brains of the operation, essentially. And because they're so central, the projections are just staggering. This analysis sees revenues jumping to over $33 billion in 2025. Net income surging past $6 billion.
That kind of scale-up story is like catnip for institutional capital, isn't it?
Absolutely. They can't ignore growth like that.
And we've seen some monster headlines recently that seem to back this up. Didn't they just announce a huge deal with OpenAI, deploying something like 6 gigawatts of AMD GPUs?
Yeah, that was massive news. 6 gigawatts. It's hard to even picture that amount of compute power. It's a colossal commitment.
And then wasn't there also news about Oracle Cloud planning to deploy, 50,000 AMD chips starting in 2026?
That's right. Another huge validation. These aren't just small wins. These are massive long-term supply deals that really cement AMD's position in the market.
So the fundamental story is undeniably strong. How does the flow data line up here?
Well, this is where it gets really interesting again looking back. The institutional buying, those inflow signals, they apparently started way back in May.
May, before those big OpenAI and Oracle headlines dropped.
Seems so. The analysis recorded 25 distinct inflow signals starting then, and that accumulation is credited with powering the stock up 102% since the initial buy signal in May.
Wow, 102%. So, okay, that raises a big question. If the huge public news came later, why were institutions loading up back in May?
That's kind of the core argument for this methodology, right?
Yeah.
It suggests that big capital often gets wind of these mega deals being negotiated, or maybe they just anticipate the competitive wins much earlier than the public does.
They see the writing on the wall sooner.
Or they are the writing on the wall, in some cases, by committing capital. The flow acts as a precursor. It confirms the biggest players are making their moves based on high-level strategic confidence before it hits the news cycle.
So it's like the difference between reading the final battle report and actually seeing the troops mobilizing beforehand. The smart money was already getting into position.
That's the idea, spotting the mobilization, not just the victory announcement.
All right, let's cover the third stock. This one's maybe the most intriguing, partly because we need a quick clarification to make sure we're being accurate. We're calling this the infrastructure lever and specialized component, SanDisk Corp. Now, the source uses the ticker SNDK and notes a $21 billion valuation.
Okay, SNDK SanDisk.
But hang on, you, our sharp listener, probably knows SanDisk itself was actually acquired by Western Digital WDC way back in 2016.
Ah, yes, good point. So SNDK doesn't trade anymore as a standalone company.
Exactly. So we need to be clear here. The source isn't making some factual blunder about the merger. It seems they're using the legacy ticker, SNDK, as a way to specifically track the high-density flash memory division and its related assets within Western Digital.
Okay, that makes sense. Sometimes tracking systems do that, especially if a particular division has a distinct profile or driver in this case, the part heavily tied to AI and data centers, separate from WDC's broader, more diversified business like hard drives.
Right. It's about isolating the AI leverage.
And that distinction is key. Institutional money isn't always just buying the biggest overall company. Sometimes they want the purest possible exposure to a specific growth engine. And this division, tracked under that SNDK umbrella, is basically plugged directly into the hyperscalers.
Like AWS, Google Cloud, Azure.
Exactly. Those giants need absolutely massive amounts of reliable, super-fast storage for their AI clusters. And that's what this SanDisk-originated division provides. It's a critical component.
So the growth story here isn't about the whole of WDC. It's about the explosive leverage this specific flash division gets from that hyperscaler demand.
That's the narrative. The analysis projects its revenue climbing sharply from 2025 to 2026. But the really crucial part: net income is forecast to swing from a loss to a significant profit, estimating around $872 million in profit in 2026.
Ah, that inflection point from red to black. That always attracts growth investors.
Always. It's a huge catalyst.
Yeah.
And the flow data seems to back up that conviction. Given this is, notionally, a smaller piece than MU or AMD, the impact of institutional buying can be even more dramatic on the price.
And it has been, apparently. The analysis says these shares, or rather the value attributed to this segment, have rallied an incredible 183% since accumulation started in late August.
183%. Wow.
Yeah, and they attribute this almost vertical move not just to general market buzz, but specifically to what they call a wall of institutional sponsorship, powerful, concentrated inflows.
That really underscores the point. Big capital isn't just chasing the obvious AI leaders like AMD. They're digging deeper, making sure they own the critical suppliers, like the specialized storage SanDisk provides, that are essential for the whole infrastructure build-out. They want the whole stack.
They're buying the picks and shovels, not just the gold miners.
Exactly. So if we just connect this all back to the bigger picture, the core finding from this source is pretty clear. Whether you're looking at a huge competitor like AMD or an essential cyclical turning the corner like Micron, or even a specialized component supplier like this SanDisk division.
The powerful stock moves are all reflecting that same thing, sustained institutional conviction.
That's the common thread. Big money is flocking to clear, measurable growth drivers in semis and data centers. It's about belief in the story. They aren't betting on wishful thinking. They're betting on monster guidance beats like MU's, confirmed mega partnerships like AMD's, or direct leverage to the biggest tech spenders on Earth, like with SanDisk.
Okay, so wrapping this up, what does this all mean for you, the listener? The source is pretty direct here. They warn we're heading into the typically strong fourth quarter, and the advice is strategic, not just tactical.
What are they suggesting?
They urge you to make sure your portfolio is, quote, armed with the best technology names attracting capital day after day. That sustained inflow, they argue, that's the clearest signal of high-quality growth right now. That's how you outperform and find those potential all-star growth stocks.
It's definitely a different lens. This kind of analysis, focusing purely on where the big money is demonstrably moving, it gives you a perspective that just reading fundamental news releases might miss.
How so?
Well, it shifts your mindset, doesn't it? Away from maybe bargain hunting for stocks that look cheap but have no real buying interest, and focuses you completely on high-quality names that institutions are actively accumulating. It forces you to ask, who has the big capital conviction right now?
Right, not who might have it later.
Exactly. And the final sort of provocative thought here from the source is really about timing and quality. They hammer home the importance of using this kind of flow analysis to be early.
Don't wait for the confirmation on CNBC after the stock's already doubled.
Precisely. Ask yourself, which high-quality stocks are building that wall of institutional sponsorship today that might become tomorrow's big headline? Their mandate is pretty simple, really.
What is it?
Be early and always go with the flows.